$2 billion for Nothing Bundt Cakes, Maya. I didn't know the premium icing market was that deep.
It's not the icing, Nate. KKR is buying pure franchise cash flow, not carbs.
Oh, come on. $2 billion is a massive sugar high. Though seeing PE drop that kind of cash while Q1 deals hit $1.2 trillion is wild.
Wait until you look under the hood of that trillion. The real driver isn't pastries. It's AI inflating everything it touches. The rundown.
$2 billion for Bundt Cakes, Maya? $2 billion?
I read the press release 3 times to make sure I wasn't hallucinating an extra zero. KKR is taking Nothing Bundt Cakes off Roark Capital's hands.
Look, I love cream cheese frosting as much as the next ex-banker, but a $2 billion valuation for a bakery chain? That is peak private equity having too much dry powder.
Roark bought them in 2021. They probably doubled the store count, slapped some leverage on it, and passed the sugary parcel. But you know what actually gave me sticker shock today? Intel.
$14.2 billion to buy back a 49% stake in their own Ireland fab joint venture.
Right. They sold that stake to Apollo just a few years ago to raise cash, and now they are buying it back? The financial engineering here is giving me whiplash.
It makes total sense, though. They are trying to consolidate control of their manufacturing base while the AI chip race is red hot. Apollo got their yield, Intel gets their fab back. Classic win-win.
A win-win, except for the shareholders who paid the financing premium on that round trip. It is incredibly inefficient capital allocation, Nate.
Hard disagree. It was bridge financing disguised as a joint venture. Standard playbook when your stock is beaten down and you need to build out physical infrastructure.
Call it what you want, it is an expensive bridge. Speaking of expensive infrastructure, the AI premium is officially spilling into renewables.
The Soluna deal. $53 million to close the Briscoe Wind Farm acquisition in West Texas.
Exactly. Analysts are calling AI M&A a tale of two cities right now. Software valuations are aggressively resetting, but anything that powers a data center? Blank check.
Which might explain why bank deal volumes are surging 42%. The regionals are merging just to afford the IT upgrades to keep up.
Maybe. I am mostly holding out for the beauty drama. The rumor mill says Estee Lauder and Puig are hashing out a massive, predominantly stock tie-up.
A stock deal in this market? Bold. But honestly, nothing touches the sheer scale of what we saw in Q1. Global deal value hit $1.2 trillion.
Heavily anchored by Leonard Green selling Jetro Restaurant Depot for $29 billion. Which brings us to the elephant in the room.
Exactly. How much of that $1 trillion Q1 bump is actually real economic growth, and how much is just private equity passing the same heavy assets back and forth? The big one. It's wild to me that everyone keeps crying about geopolitical stress fractures, and then you look at Q1 global M&A and it's sitting at $1.2 trillion. Record territory.
But look at what's actually holding that number up, Nate. You strip out the Jetro Restaurant Depot deal, and the private equity exit market looks completely different.
Okay, but you can't just strip out a $29 billion deal because it ruins your bear case. Leonard Green and Partners pulled off a monster sale.
I'm not ignoring it, I'm looking at the distribution. Jetro is a massive outlier. Wholesale food distribution to local restaurants is basically inflation-proof. They passed every single cost increase down to the consumer. That's not a signal that the broader PE exit window is wide open.
I disagree. I think it shows that if you have a premium asset, buyers will still pay a premium multiple. It's exactly what we're seeing with the AI bump right now. You have analysts calling it a tale of two cities.
Right, which means unprecedented demand for data centers, while software valuations are getting aggressively reset. Soluna Holdings just picked up a 150 megawatt wind farm in Texas for $53 million just to power this stuff.
Exactly, the cash is there. Which brings me to my absolute favorite premium asset of the week. Forget data centers, KKR is buying Nothing Bundt Cakes.
For $2 billion. $2 billion?
Roark Capital just flipped a cake company to KKR for $2 billion. Tell me the M&A market is dead, Maya. Look me in the eye and tell me it's dead.
Technically, they're Bundt cakes, not cupcakes.
Don't ruin my momentum.
Have you ever actually looked at the unit economics of a Nothing Bundt Cakes franchise? Nate. Voices.
So I saw this note from a research desk this morning calling AIA, quote, tale of two cities for M&A.
Oh, we are quoting Dickens now.
We are. It is the best of times for data center infrastructure and the worst of times for software. They are saying AI is driving unprecedented demand for the hard assets, but aggressively resetting software valuations.
Aggressively resetting is just polite analyst speak for multiple compression. But I completely disagree with the premise. It is not a tale of two cities. Software valuations were already heavily inflated. AI just popped the balloon faster.
You do not think the infrastructure premium is real? Look at the sheer capital required right now. Intel is buying back that 49% stake in its Ireland fab joint venture for $14.2 billion. $14 billion. Soluna just bought a West Texas wind farm for $53 million just to lock in the power capacity. The hard assets are the entire story right now.
The infrastructure premium is real, sure, but the software reset is totally separate. Wait, did you see the other quote floating around today? The one about bank M&A?
The throttle up moment.
Yes. Who writes this stuff? They are saying bank deal volumes are surging over 42% because regulatory uncertainties are finally easing.
I actually buy that one. Bank executives have been sitting on their hands for 2 years, terrified of regulators. Now they smell blood in the water. 42% is a massive jump.
It is a 42% jump off a baseline of practically zero. A 42% increase on nothing is still basically nothing. If you look at the actual absolute deal count, it is pathetic.
Spoken like a true journalist reading the footnotes, but momentum is momentum.
Fine. Speaking of momentum, I want to talk about something that actually dictates it. Let's look at how volatile energy markets and Middle East tensions are threatening to blow up deal financing for the rest of the week. Spill the tea.
I am telling you, the whispers out of Paris and New York are getting incredibly loud. Estée Lauder and Puig.
A predominantly stock-based tie-up, which is exactly where this rumor completely loses me. Have you looked at Estée Lauder's chart lately?
It is not exactly pretty.
It is a cliff dive. Why on earth would the Puig family, who literally just took their cosmetics empire public, want to trade their shiny new equity for Estée Lauder paper?
Because it is a massive portfolio play. You put Charlotte Tilbury and Ray-Ban in the same house as MAC and Clinique, you own the premium mall floor. Plus, Estée desperately needs the cool factor. Puig has it.
I get the narrative. You are selling me the banker pitch deck, but the math is entirely sideways. Puig is trading at a premium. Estée is in a messy turnaround mode. If this deal actually closes as a stock swap, I will eat a tube of lipstick.
I am holding you to that. I prefer the shade Velvet Teddy for the record.
Duly noted, I prefer cash deals. Speaking of dragging things out, Gilead is playing games again.
The Arkelix tender offer.
Right. They just extended the expiration date. Again. Just keeping investors on their toes for fun, apparently.
It is classic pharma strategy. Delay, make sure the clinical data is absolutely bulletproof before you actually clear the transaction.
Or they found something weird in the IP footnotes during late-stage diligence, and they are trying to sweat them out. I always assume the worst.
You do. It is your best quality. But look, whether it is makeup or biotech, everybody is trying to lock in their structures before the macro environment gets any uglier.
Oh, you mean the volatile energy markets and Middle East tensions threatening to blow up deal financing costs for the rest of the week?
Exactly, which is exactly what we need to look at next. Tomorrow's radar.
I'm obsessively refreshing the NASDAQ board tomorrow to see if RTB Digital finally gets listing approval.
You actually care about the RIVEL merger. It's a rounding error compared to what volatile energy markets are doing to deal financing right now.
I care because the filings are a mess, but yes, Middle East tensions are definitely spiking the cost of capital.
Which is exactly why I'm watching the Estée Lauder and Puig rumors. The whisper is a massive, almost entirely stock-based tie-up.
Stock-based? Oh, come on. You really think the Puig family wants Lauder paper right now? Lauder is bleeding market share.
It's an elegant solution when debt is this expensive. You sound like a stressed out credit committee.
Somebody has to run the numbers. Speaking of delays, Gilead just quietly extended their tender offer for RSLX.
Just buying time, or is the deal in trouble?
The footnotes suggest a regulatory headache. We'll find out tomorrow.